Peter Churchouse, Managing Director and Head of Research at Morgan Stanley, who joins us from our studios in Hong Kong. Peter, it's no secret there will be no move in rates in the US today. So is it fair to say that what we're really looking for from Alan Greenspan is whether he thinks this recovery has any serious momentum?
I think that's absolutely right. The assessment of the Fed over the last 12 or 15 months has been very clearly that the risk to the economy has been to the downside. I think the message we're going to get from the Fed this time around is that the risk is to the upside for the US economy. But I don't think the Fed is convinced that this is a sustainable recovery just yet. So I think the message will be, yes, we think things have changed, but we're not convinced that this recovery is going to charge ahead at any great rate of knots at this early stage.
You have to feel sorry for the man, really, to a certain extent, because if he says, yes, it's good news, the economy's on the way up, we're going to worry about interest rates. If he says, don't worry about interest rates, we're going to start thinking, oh no, maybe this recovery is going to fizzle.
I kind of think this is a quality problem to have. I think a growing economy is better than the risk of a very deflationary environment for the world. So I'd rather see, quite frankly, a risk of economic growth to the upside. I think inflationary forces in the world are quite benign anyway. So I think any upside to interest rates is likely to be very modest and very tempered because of this very benign inflationary outlook.
Well, how strong do you think the upside is going to be? Because what we're really waiting to see still, despite all these predictions or generally expectations of growth, is any pickup in demand.
Well, yes, I think it is happening. I think there's clear evidence of that. Industrial production numbers are up. NAPM numbers are up in the US. Inventory numbers are suggesting that as well. The consumer's been relatively strong. Our own economists in the US have lifted our economic forecast to from about 1.25% to 2.6% just recently. So I think that's a generally consensus view that that is the sort of level of recovery that we're facing, I think, going forward over the balance of this year. And I think the risks to that are probably to the upside.
How will the oil price rise in recent weeks play into this rally?
Well, that, I think, is one of the key factors behind why perhaps the Fed is going to take a fairly moderate stance here, because that may well be one of the uncertain factors that lead perhaps to a quelling of this economic recovery in its early stages if we see oil prices moving back up above 30 towards $35. And I think there clearly is some concern that we could be headed in that direction. So that, I think, may be one of the factors that keeps the Fed in a fairly modest, benign position here.
Let's work on the assumption that we're going to see all our best predictions coming true for the United States. How is that going to play through for Asia? Because in the Wall Street Journal this morning, a very interesting article talking about how the Asian economies actually don't depend that much on exporting to the States.
Well, I think that's true for some economies. For example, China is really exports in the Chinese economy are only about 22% of GDP. But however, in the case of Korea and Taiwan, in particular, I think that is the U.S. economy, and particularly in the technology sector, is very important to those economies. So I think what we're seeing here is, if you like, a slightly different reaction in stock markets to reflect this dependence on exports, particularly technology. And you've seen that the Korean market is responding very, very favorably indeed. It's highly leveraged to the exports of technology products to the US and other markets, of course. So Korea, I think, is going to respond quite differently, perhaps, than, say, a market like Hong Kong, which is largely a great deal more interest sensitive, shall we say. So I think Korea may diverge quite significantly from markets like Hong Kong and Singapore.
I think the point Journal was making actually was an analysis of GDP as opposed to the markets themselves and equity values. But let me finish off with the equity story here, Peter. And again, going back to the original question, exactly what the markets are expecting. And it seems that it's all been priced in. So given that scenario, do you expect any great movement when the final words come out?
I don't think there will be a great deal of movement. I think people have been expecting this. The numbers over the last couple of weeks have been suggesting that. And in fact, comments from the Fed itself, various board members and Mr. Greenspan himself have, I think, led the market to this view. So I don't expect to see any sharp reaction from markets here by the FOMC meeting today at all.
Peter, thank you very much indeed for being with us. Peter Churchouse, Managing Director and Head of Research at Morgan Stanley, joining us from our Hong Kong studios.